It's been a wild ride. Lima, when I started, was doing 300 million a year, and this year we're doing 3 billion in a mix of products. And to date, I've done 1,700 closings. I average probably about 200 to 300 a year. And my success rate, meaning that if you submit an application with me, out of 10 times, that loan funds. So I am customer crazy. I know our products frontwards, backwards, and side to side, and I can help people get across the finish line.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Brandon Campbell. Brandon is a top producing loan originator at Lima One Capital. He joined Lima One in 2016 as an entry-level inside sales rep and moved quickly up the leaderboard. Over the years, he has consistently been one of the top 5 producing originators at the company. Loans are a crucial element of almost any real estate deal, and right now that environment is challenging at best, so I am ready to get into it. Brandon, welcome to the show.
Thanks so much for having me.
All right. So before we get into loans and rates, please tell us how you got started in real estate and how you got to where you are today.
Yeah, in 2016, I graduated college, and I had $250 in my bank account. And a good close friend of mine was working at a little company called Lima One as one of their accountants. And he said, we're growing like crazy. We're doing a bunch of cool stuff. And he said, do you know anything about the mortgage industry? I said, absolutely not. And so I like to say that Lima took a chance on me. I was the first person hired for our inside sales team. And then over the years, I grew that to about, I think it was 25 at its peak when I was over leadership of that department. And then my boss came to me and gave me a fork in the road. He's like, hey, do you want to be an originator or do you want to be a boss? And I said, I would absolutely want to be an originator. There's more money there than managing people. But yeah, it's been a wild ride. Lima, when I started, was doing 300 million a year. And this year we're doing 3 billion in a mix of products. And to date, I've done 1,700 closings. I average probably about 200 to 300 a year. And my success rate, meaning that if you submit an application with me, out of 10 times, that loan funds. So I am customer crazy. I know our products frontwards, backwards, and side to side, and I can help people get across the finish line. So if you want to close a deal, I should be your first call.
Awesome. All right. So just to kind of level set, tell us what a loan originator is and what they do. And for who? Yeah.
So a loan originator mainly is a salesperson hired by a mortgage company who sells their products and their services. There's licensure involved for those that are unfamiliar, and the specific, I guess, what federal guideline is have to work for a certain originator. So I'm a Lima One sales rep. I sell Lima One products. And I've been successful over the years and helped cultivate relationships and rebuild America's neighborhoods.
Awesome. So give me a kind of like a profile of what your customer base looks like. Are these, individuals buying their first starter home? Are these primarily investors? What does that look like?
So our customer base is actually pretty vast. So we can work with first-time investors, first-time flippers, first-time landlords, but we do that. But as well as on the opposite end of the spectrum, we have customers that have an office of 30 people and have a CFO and have accountants and have people sourcing deals for them. Our appetite's pretty vast, but I would say the majority of our loan volume comes from well-established customers who have purchased at least dozens of homes, I would say. But we won't turn somebody down just because it's their first deal. We have the appetite to help them get started into real estate.
Sure. And what does the average loan size look like for you guys? And what's that range?
Yeah, so I would say globally across like all products, everything that we do, our average loan size is probably around 300. We're first and foremost primarily a single family lender. So the majority of my business, probably 60 to 70% is short-term fix and flip loans, ground up new construction of single family homes. And I'm calling you from Greenville, South Carolina, and we have a heavy presence here in the Southeast. So the majority of our loans are probably in the Carolinas, Georgia, Florida. So that leads credence to the $350,000 roundabout loan amount.
Okay. And this show is multifamily focused. Talk to us about that subset of customers that you have that are doing either, small multifamily, so 2 to 4 units, or commercial multifamily, 5 and up?
Yeah. Again, the bulk of our business is that single family category, which is anything 1 to 4 units. However, we do not shy away from apartment complexes. Majority of our business is short-term bridge loans, either value add loans or maybe like these quasi-perm bridge loans, which we can get to a little bit further. But the customer there, and logically speaking, as we've been a single family lender, we've helped people graduate to the next step. So there's many of instances where people have come to us and say, hey, I bought 50 homes with you and I want to buy a 20 unit. Can Lima help me do that? And the answer is absolutely yes. So we've seen a logical progression of people just graduate to other asset types and larger projects over the years as they worked with us. But it's not to say that's all. We work with well-established multifamily investors. We've had people come to us that have bought storage facilities and other commercial buildings, and they want to buy a 150 unit in a tertiary market in Mississippi. And of course, we're game for it. If there's a good sponsor with a great deal, we're going to find some way or another to plug them in with us.
Okay, so let's talk a little bit about short-term bridge loans, because that's something that a lot of people were doing the past couple of years, but now it has become unsavory, I guess is a word that I would use, based on some of the things that are happening in the market. Give me your case for what you think about short-term bridge loans and where they still do make sense.
Yeah, that's actually a really good question. Last year, I would say the majority of projects that I reviewed, that I underwrote, and that I submitted to our underwriting team, not just me, but the other, what I would consider our other commercial real estate loan officers, is we get a lot of bridge-to-bridge requests. So there's a lot of instances where folks were in the middle of a project and they bought it in 21 and 22, or even 2020. And of course, like we knew the headlines, which was labor shortages and crazy material issues. And so what we've been able to do as a firm for those projects that did make sense is we came in and we were able to give them rehab, extend the project life, and let them still remain successful and have successful exits. So by the unsavory word that you used, that was with the banking crisis that happened last year, we found that there was a lot less players in the field. A lot of people didn't want to do it. And then just commercial real estate as a whole, I guess like all the bad headlines from office got looped onto multifamily. It's not all commercial real estate that's bad. So there are some projects that absolutely did struggle. Sponsors did not manage and did not steward their funds well or steward the project well. And there were some others that legitimately ran into some issues. And those sponsors that we felt as if had legitimate reasoning as to why their project stalled, we wanted to continue and help them. What was also interesting is last year was a great opportunity for us as a firm, just because, again, we had the banking crisis caused a lot of ripple effects with the regional and local banks. They just wanted to clutch their pearls and not really want to lend anymore. And then also another thing worth mentioning too is we are a fixed rate lender, and with the inflationary crazy interest rate environment, a lot of folks did not want to have a floater. They would want something tried and true in a fixed rate. So we had this perfect storm last year of we had a lot of great projects that were stalled, great sponsors, and we were able to take the ball at the rim and help them run with it. Matter of fact, last year was one of our larger years in multifamily. A lot of these were these bridge-to-bridge refinances. But it's not to say that we only focused on these failed projects, of course. Bridge financing has a very legitimate purpose here in 2024. It absolutely has a legitimate purpose. A lot of what I'm seeing the use case of these bridge loans now is, and what I'm speaking of in particular is not a value add, but like a stabilized bridge is what we call it. So it's just a short-term loan for 2 years or 3 years. Interest rates very well may drop in the immediate to mid-future. So these bridge loans are the perfect solution right now for folks that are trying to bridge the gap between their current value add loan and the perm loan they'll ultimately get with Fannie, Freddie, or HUD. So we felt a niche in the market, and we filled that niche with offering these 2 or 3 year bridge loans for these either projects that are the only thing they need to do is get occupancy up, or they need to season the occupancy, or some folks are waiting on COs, but they have the TCOs, but they can't quite get the permanent financing yet. So we've filled that need there. And that's where we stuck out in the market. Again, fixed rate and then 2 or 3 year bridge term, these quasi perm terms are really attractive to a lot of multifamily operators nowadays, just because we can give them what they need now, the cash out or the extra time that they need, and then they can actually go get the loan that they love after the rates, Lord willing, come down the next year or two.
Yeah, and I think maybe I don't want to say misspoke, but it should have specified when I say bridge loan, and a lot of people hear bridge loan, they think variable rate, right? Because so many of them were variable rate.
Yeah.
And so then when rates started to go up, a lot of people got in a bad place. But what you're saying is that most or if not all of those bridge loans that you did were fixed rate. Is that right?
Well, 100% of them are. So we are a fixed rate lender. So that's awesome. What made us, probably one of the more attractive options in the past 12 months. And so this is what separates our product is that, and also another thing as well, just to talk about misconceptions, we're in between two categories, I would say. So there, over to the extreme side is hard money and over to the extreme side is bank financing. And we're in between the two. And so I want to cut that hair there or split that hair there, because with hard money, it's a not well capitalized office. And of course, we all know the connotations of hard money, which is knock 3 times to get a bag of money thing. It's more common on the single family side. And then with bank financing, there's the misconception or the very true conception of, hey, I've spent all this paperwork and it's just crazy and it takes forever. And there's 5 committees and I have to talk with the VP and I have to open a deposit box or something crazy. Yeah, we're in between the two. I've heard stories of people flying into cities that they want to buy in and meet with a VP and talk about opening an account with them. It's very real. People have to do that stuff. We're in between the two. We are a well-capitalized lender. We're owned by a publicly traded company, MFA Financial, and they've been instrumental in helping grow our business. We're well-capitalized, but we also have the willingness to go around the edges with certain projects, some deals that have a little hair on them. Now, that's not an outright saying that, yes, we love hairy deals. I love 100% of hairy deals. No, I'm not saying that. But we will look at deals with hair on them, and then we're a little bit more nimble than a bank, but we still have underwriting guidelines. So we're the best of both worlds is the point that I want to make. So we're a lender that meets the need that banks fell out and hard money lenders that they just couldn't keep up with in the here and now. So fixed rate lending and then a balance sheet lender in this market is extremely valuable, especially to a lot of multifamily operators.
Yeah, that makes a lot of sense. And it surprised me and maybe it was just an example you were using, talking about lending to a tertiary market in whatever state. Like a lot of banks will not loan in tertiary markets just because of the risk involved, right? It's just not as much of a sure thing as the tried and true primary and secondary markets where you're going to have population growth, et cetera.
Yeah, absolutely. We don't necessarily have a population requirement, but it just has to make sense. So is there a job center there? Is there a, not a decline in population, but at least a steady population growth? Also, Is it the asset class that makes sense, or the grade, like a C+ property in a tertiary market makes a whole lot of sense than a Class A property. So it's just, we look for those kind of things. We're in the business of lending money, and unlike a bank, that's our primary business, and that's what we want to do. So we're going to find a way to get a deal done. So I'd rather say yes than no. Open a safety deposit box, please.
Yeah, and so there's one more thing that you said that I wanted to hit on, and that's the vetting of sponsors, right? If the sponsor is good, that's how you as a lender determine whether or not, hey, this person is worthy of entrusting with my money. And passive investors, in a sense, need to do the same exact thing, right? They need to vet these sponsors because they're handing over a big chunk of money. It may not be as big a chunk as yours, but it's a big chunk for them. So talk to me from the lender's perspective, what does the vetting of sponsors look like?
Yeah, so a lot of this is just classic common sense. So this guy wants to buy a 100-unit building. Has he done anything similar to that before? And the answer is no, then it's an easy no. And then also going back to the previous example I gave, this guy, the folks that I was talking about, they've done a myriad of single families with us. We've seen their construction process, and they want to buy a 20 unit in a market where they already own 50 units in. Absolutely. That's an easy yes. The issues that I run into primarily are, I want to buy a huge unit count out of state. I don't have any presence there. I don't have any crews there. I would figure it out. Things like that. You're not within a reasonable distance of the property to manage it. I'm okay going across state lines as long as it's within a reasonable driving distance. If you can be there within a few hours and then you own some other properties, then yeah, it's just the story has to make sense is really it. And that also goes down to net worth. How much money does this guy have? Well, how much liquidity does he have? And then how much LP money is he raising versus how much money is he actually putting in? So those are all just the common sense questions that we asked when we vet sponsors. But generally speaking, it's as long as, and also this is just a word to the wise, when you're pitching a deal to a lender, especially somebody like a Lima One, you just got to make sure that your story makes sense over the objections ahead of time. So where the deficiencies are, like, I don't know this market, my net worth is this, my liquidity is this, what are you going to do to overcome it? Are you adding a partner? Do you have a partner that has some presence in the area? Those are just the basic things that we look for, just common sense.
Yeah, no, and all of that does make sense. So just for the listeners to roll up some of the things that you talked about. One, track record, right? That's one of the most important aspects. Two, boots on the ground. Mm-hmm. Are they one of their partners in the area where the property is going to be located so that they can have eyes on? Liquidity and then net worth. Can you talk about those last two for me and just give me a better idea of what your requirements are as a lender for both those things, liquidity and net worth?
Yeah. So generally speaking, liquidity wise, I would want to see at least 5% of the loan amount, especially if it's a larger apartment complex. And then for smaller projects, single families, generally speaking, I want to see the cash from borrower at closing plus a few reserves for monthly payments. So it's not crazy high liquidity requirements. At the same time, it has to make sense. So if the equity requirement's $1 million and you got $250, where's the other $750 coming from? We want to see it ahead of time. We want to do a KYC and know where that money's coming from ultimately. Now, net worth, generally speaking, we want to see the net worth is equal or greater than the loan amount that's in front of us. Now, we're nimble in the fact that a lot of times we have blinders, like we're just looking at the deal that's in front of us. Whereas more common with bank financing, there's a global look of everything that you have out. Generally speaking, Lima's just looking at what we have in front of us. Now, of course, common sense, if you want to borrow $50 million from us, we want to see how the rest of your financial life is looking like. But generally speaking, we're just looking at the liquidity and we're looking at the net worth compared to the deal that's in front of us, just for sake of ease.
Yeah, and is it pretty common for a sponsor to just bring in a KP that has that net worth and or liquidity so that they can make that deal happen?
Yeah, that's a part of it. If you're lacking in one category or another and you always bring somebody else that's willing to sign a personal guarantee, then yeah, we can make anything work. Almost.
Okay, and I don't know, how much do you guys look at the sponsorship team, and do you have any concerns as to size, right? Is either too small or too big, right, for whatever the asset size is? Does any of that concern you guys?
Yeah, that's a good question. So right as of this recording, we cap out at $10 million. So I don't want to do the crazy Class A Miami condos. We're middle market. So that's really where we spar. And also the lens too. This is important to mention. So Lima started as a single family lender, and we started in Atlanta. We're a single family lender first, and then we do multifamily second. It's probably the best way to describe it. We do it well by all means, but we have a single family lens on a lot of the things that we do. And I view that as an advantage just because we're deal makers is really what it comes down to. And we can be a little bit more nimble and have a little bit more, we're used to some certain things on the single family side that kind of trickle over to multifamily. Maybe a little bit heavier rehab budget, lower vacancy than what you would see with some bank lenders. And that's where we fit.
Yeah, and I think that's important to clarify, right?
Yeah.
Because there's some folks out there doing some really huge deals. But there's also folks who were like me starting out with, say, a duplex and maybe a triplex. Maybe they're ready to go up to that, even that sixplex or that 10plex. You can still help them with everything within that range. Again, assuming we're not in some ludicrously expensive market. We're talking normal here, because you're saying 10 million and under is where you guys play.
Yeah, that's generally it. But yeah, I can help people with the logical progression. So like I want to buy a duplex, and then I want to buy a triplex, and then I want to buy a sixplex, and then I want to buy a 20 unit. Yeah, we have the financing for it. Now, of course, it's not It's not without underwriting guidelines and things, of course, but yes, absolutely. Those are all things that we can look at.
Okay. No, that's great. And so that's the other thing that I was going to ask you about anyways was like the various asset classes that you guys work with. Do you work with anything outside of what housing? Do you do any office or even mobile home parks or self-storage, any of those other alternative assets, I guess I'll call them?
Yeah, that's a good question. We're a residential lender is probably the best way to describe it. So like single families, multifamilies, the most that I get crazy is with mixed use. Generally speaking, I want it to be majority residential, and then they can have a storefront on the bottom, or primarily a resi lender.
All right. And what about short-term rentals? Is that something you're seeing a lot of? And is that something that you guys are willing to lend on? Or I didn't know if there's a higher risk for you guys involved in that. Just curious on that piece. Because I know a lot of folks listening might already have short-term rentals as well.
Yeah, we love short-term rentals. We do them. I offer permanent financing for 1 to 4 unit short-term rental properties. Now, basically how we vet it is and what I would say was what in this case, like for me to lend on a short-term rental, I would want to see a track record with one previously, just one. If you have a 12-month history with a short-term rental, then you can get in the club, so to speak. How it works is we'll look at the lesser between the actual rent or the AirDNA income, whatever's lower. And we haircut it a little bit around the edges. If it's not, especially if it's a purchase, generally speaking, AirDNA is the data that we're going off of, haircutting it a little bit. And then as long as it pencils to a 1.3 DSCR, then you got yourself a permanent loan. And I could say where we're best at with short-term rentals and where I found this and just experimenting with it. But typically, and this is not exact science, but if it's under $1.5 million, generally speaking, I can give it LTV that people like, which is up to 75%. But short-term rentals, they're not like the number one thing that we do, but people still do them and they're successful at them. And again, it goes back to good sponsorship. So like we want to make sure that these people have done it before, they have a team set up, they live within a certain distance of the property or have a property manager. But yeah, we're open for business with short-term rentals. I would say a lot of our business is the BRRRR method with single families by rehab. I forget the R's now, but there's a guy called me one time. I want to do a BRRRR and B. Like, yes, we do BRRRRs and Bs. Funny little moniker, but yeah, absolutely. I'd be willing to help out folks with short-term rentals.
Yeah, and admittedly, short-term rentals is not something that I've tried. I almost bought one here in St. Petersburg because I was like, hey, I'm in Florida, right? I'm in Tampa. Yeah. So great location for people going on vacation, stuff like that. The thing that's tricky sometimes with short-term rentals is the laws associated, because it's not even state laws. It goes down to county,
the local, local
city,
level.
And right. It's a hyper local level. And so you have to be sure that you're even legally allowed to do it, because otherwise you could just get yourself in trouble, if you have to backtrack after that. And so I wound up not going that route, but I know plenty of people who specifically in Tampa have been very successful doing like higher end short-term rentals where they make it like super Instagram worthy on the inside. I think the other challenge with short-term rentals from my perspective is similar to why I was asking you, is how to underwrite them, just because of the elasticity and how much they can charge based one month to the next. But maybe there's a way to average it out looking at models, because there's comps, right, that can show you over time how much they make in a week, month, year, and then I assume that gets averaged out so that you can get a guess as to what the income would be.
Yeah. And then another thing worth mentioning too is I'm plugged in with an investor. He's in the Midwest. He has a podcast as well. Shout out Kirby Atwell. His podcast and his masterclass is about how to think about the worst case scenario and about these short-term rentals. So like what he buys is primarily in the Midwest, so lower property values, in places that have both a mix of touristy areas and also have a good, strong rental base around the lakes in Michigan, places like Michigan City, Indiana. There's nothing special about Michigan City, Indiana. I've done a bunch of short-term rentals there because there's a mix of both normal rentals and then also looking at markets where you could pivot and do either or, and especially with the multiple units too. Like you could Airbnb the bottom two, and then you can have normal tenants on the top. So just thinking about like the worst case scenario, because you're exactly right. There's a lot of, down to the local level. I've looked at short-term rental deals in, I forget the exact cities in Florida. It's okay. You can have a short-term rental tenant, but it can only be like a month at a time, or like you can only have one tenant a month. And so that's just, people aren't renting these units for a month at a time. It's a weekend, it's a week. So it just kills that market. But some places in the Midwest are a little bit easier to do. I've even done short-term rentals I've done a log cabin short-term rental in West Virginia, of all places. Property value was like $200,000, and the guy was getting $5,000 a month on AirDNA, what we underwrote to. It's just specific to the area. But there's other places, so like more local to me, Charleston, South Carolina, they have overlays. So like the county has come up with a grid where you can buy a short-term rental, you can operate a short-term rental, have a customer that does that and is successful. And of course, the second that you figure out that your property is in one of these short-term rental overlays, then the property value just shoots to the roof. There's a lot of tricks to the trade here, but primarily if you can look and vet a property that can pivot and do either or, then I think that you'll be more successful in the long run.
Yeah, that makes a whole lot of sense. All right. I would be remiss if I didn't ask about rates before we move on. So
Sure.
Talk to me about where rates are right now and where you think they're going in the future, acknowledging that your crystal ball isn't any clearer than mine.
Yeah, that's exactly right. So I do not have a crystal ball, but I do anticipate, and another thing worth mentioning too. So, before I answer your question, which I will, another misconception that I run into is, okay, the Fed dropped the rates by 25 basis points. So therefore all rates drop by 25 basis points. It may be true of residential mortgages, but it's not true of the business purpose space. Like how our coupons are determined is through what our weighted average coupon needs to be when we sell the mortgages. It has to be at X, Y, and Z in order to sell the note for a profit. So we want to make sure that everything that we do matches out, and so we can be profitable when we actually sell the notes. Generally speaking, nowadays, for a fix and flip, for a top tier guy, I can probably get in the 8s. And then for a first timer, I'm like 12 to 13%. And then somewhere in the middle, we're somewhere in the middle. So I've done 9, 10, 11% for people with probably 5 to 10 flips. The top tier guy I would consider has done 24 deals in 2 years. I can get you down maybe high 8s, low 9s, and then maybe a point, maybe less, depending on the deal. Now, with rental financing, we actually just lowered rates, which is exciting. We're more firmly in the 7s, like higher 7s, maybe low 8s, higher LTVs. And then with multifamily, again, we're bridge lending. So it's like, I think the lowest I've seen is like 10.5 to 11-ish, depending on LTV, LTC, and all that good stuff. But that's a global view of where it sits as of the recording of this. But now, the interesting question is, I think rates are going to go down. I said to a colleague yesterday, I just wish something would break. Like I want either housing prices to fall 40% or I want mortgage applications to go to 0. If something breaks, then the Fed would have to act really quickly, and then we'll probably see some rate decrease. But we might be holding not steady, but we might see some small decreases. I hope the Fed decreases rates this year. I think they came out last week and said that they were going to hold steady this most recent meeting. But yeah, I would imagine that we're going to see some rate drops, but I don't think that we're going to have 3% resi mortgages again for a while, if ever again. But we'll see some tapering off, I would imagine, in the next 12 to 18 months. Money will get cheaper one way or another. Something has to break, hopefully, and then we can get there quicker. But that's my hot take, not necessarily Lima One's point of view.
Yeah, and I'm with you. I think it's going to happen. I don't think it's going to happen right away, and it's not going to be dramatic, right? It's certainly not going to drop nearly as fast as it rose, and everyone just needs to accept that and not be delusional into thinking that it's going to drop down to where it was, because that simply is not going to happen. Certainly not anytime soon. But any relief is relief. But at least on the commercial multifamily side, it's going to take a lot for it to even get down to below like the rate caps that a lot of people have in place. Everyone's like begging for it to go down, but I'm like, you understand we're well above the rate caps right now. So it would still take a lot just to get below the need for another rate cap. But I think everyone's just looking for any good news on that front. So it almost doesn't matter. I don't want to be that guy who's just souring the mood for everyone. But
yeah, so I would say that like we did lower rates 2 weeks ago. So there is some downward pressure. Now, how far down that's going to go in the next 3 months, I would love to know. Of course, they're not going to tell me, the sales guy, because I'd say, hey, just wait 2 weeks and then I give you 50 basis points off. But things are moving down, I would imagine.
Yeah. All right, let's go ahead and move it into the turbo round. I'm going to ask you 3 questions that I ask every guest on the show, and I just ask for a relatively quick, honest answer. You ready?
All right, let's go.
All right, first one. What is one red flag every investor should look out for?
All right, so I'm going to take it from the lending perspective. But when you call a lender and they either don't fully explain the process or they don't tell you what something is or what's your rate. Okay, depends. What's your rate? Like I did previously. Like I typically give ranges because there's ranges. There's things that change. But not answering a question directly, I think is a huge red flag.
Yeah, no, I'm with you. Transparency. And if someone isn't answering your question, that's a lack of transparency. Okay, next one. What is a myth about this business that you would like to set straight?
Yeah, that you can get started in it. I fully believe that anybody is capable of starting their journey in real estate. And it takes there's a little knowledge, there's a little research you have to do, a little education. But I believe that anybody is capable to build wealth. The majority of millionaires in the country made it through real estate. I believe that common misconceptions is too hard.
Awesome. I agree 100%. All right, last question. What does success look like to you?
I don't think we ever arrive at it. If we keep looking for it, then I need a good carrot at the end of the stick. So I will never say that I'm successful. I want to say that I'm chasing it.
There you go. You never reach it. It's not an end state, right?
That's right.
All right. Hey, Brandon, this has been awesome. Please tell our listeners how they can get a hold of you and if there's anything else that you'd like to share with them.
Yeah, I'm not too hard to find. I'm the only Brandon at Lima One, and that's my email address, brandon@limaone.com. So if you got a deal, you want to banter about the real estate market, or you want to buy your first fix and flip, I'm your guy. Email Brandon@Lima1, the only one. And then the last thing I'll leave you is that I'm in the business of relationships. I just happen to do mortgages. So I've helped people quit their jobs. I've helped people rebuild America's neighborhoods. I've helped people flip their first house, and now they're doing 5 a month with me. So it's a very it's reality that you can build wealth in this industry, and you can quit your day job and do real estate investing. And I can help you.
Awesome. Again, Brandon, thanks for coming on the show. I appreciate you and look forward to continuing to see you do big things on your journey to multifamily millions.
Thanks.